box. And we have Denise. She's our marketing director of Faucassin. She's going to monitor that chat box and, interrupt whenever there's questions, because there's a lot of content here. And sometimes it's helpful if you know how it applies in your own business. I really do try to cover a wide scale of where your business may be. Maybe you're the sole realtor, maybe you're part of a team, maybe you're even a broker. So at Faucassin, we actually took a pretty intense deep dive into the real estate practice as in general, even with developers, land developers, rentals, very heavy in all of these markets. And so we really understand the rules and the nuances in this industry. And I especially took it on probably about 20 years ago. And so I'm going to cover some topics too that even go into like-kind exchanges and give you just that high level so that you just know enough, to recognize it. And then of course, be able to refer them to, professionals to take them through it. So again, we encourage any questions. I have actually been in this industry for 30 plus years. And I got bit by the accounting bug very young in high school, took an accounting course and loved it so much that I stayed with it. Very passionate about it. I was born and raised in Delaware, and the market that I primarily serve is the Kent and Sussex County. Faucassin has offices in Dover, Delaware, Rehoboth Beach, Delaware, and Ocean City, Maryland. And we're very, very proud of our market, that we serve and how diverse we are too. So I'm the director of entrepreneurial services, and really what that does is it helps clients with accounting and advisory services. There's a lot of large companies out there that can afford the controller, or they can afford the CFO, but small businesses often can't. But they need help and representation too. So that's my passion, and my main focus is to make sure that small businesses can navigate what is sometimes a very complex tax landscape. And it's ever changing too. I mean, right now, I'm going to talk about some changes that are coming up at the end, but right now things are fairly quiet, but even when they're quiet, they're still a little confusing. So again, feel free to, ask me any questions along the way. First, I'd like to talk about just your new business startup plan. I get asked this question a lot because whether you're been in business for a couple of years, you may be thinking about a different level now, or maybe you're just starting out, or you say, wow, I jumped full on in, and now let me take a step back and really try to understand what I did and make sure I'm in, the right entity. So right now, when you start practicing as a realtor, you're a sole proprietor. And what that means is you just file your business on your personal return, and you report your income and minus your expenses, and then you pay your tax. So there is a thing called a limited liability company, and it's a statute in the state of Delaware. It was way back in the 80s. It's more prevalent now. And this doesn't change anything for you tax-wise. I get asked this all the time. Well, does an LLC save me taxes? No, an LLC is not treated any differently for taxes. The IRS says whatever you were before the LLC, you're still it after. So whether you're a sole proprietor, a partnership, which is two or more people in a business entity dictates a partnership, you're still an LLC. But an LLC, and again, I'm not giving legal advice, but an LLC gives you that limited liability protection, kind of gives you a little bit of a divide between you and your company. Now, some people will say, well, I have liability insurance. Why would I need an LLC? Again, it's just that extra layer of protection. You have insurance, you have an LLC. We're just trying to help you protect your personal assets. So if you do form an LLC, though, it's very important that you do not lose sight of filing with the Secretary of State every year. There's a franchise tax, it's called. Even though it has the word tax in its name, it doesn't have anything to do with what I do. I don't file those. That's something you have to file. Delaware does allow you to be your own registered agent. And that can sometimes be good because yes, you can save, a couple $100 a year, but it can be bad in that if you get any kind of notifications and you changed your address, you could miss that. Whereas if you're using a service, they're going to remind you. There's also a new filing requirement. So if you think you're going to form an LLC or a corporation with the state of Delaware, you do have to file a form within 30 days for new forming. And then they're thinking about trying to get it expanded to 90 days because that's a very tight time frame. And then they also, if you're an existing LLC, so this is important if anybody on this webinar is an existing LLC or corporation, you have a year to file this form. If not, there's a $500 per day penalty, and it's called a FinCEN. We're going to have, Fawcassin has a newsletter. We'd be happy to add you to our subscription. We're always putting out this kind of content. We also had someone from the industry, from Corp One. It's also a Delaware-owned business, on our most recent podcast, Accounting and Accountability, which is actually dropping today. We also had her on, and she took us through that requirement. So we're really trying to educate everyone as far as this goes. Did I hear? Oh, okay. Sorry, Denise, I thought I heard you. All right. So once you form your entity, you're going to want to get an employee identification number, an EIN. This is kind of like a social security number, but for your business. And again, it's that separation. It's kind of nice. Like in today's world, we're so nervous about identity theft that we should probably not have our social security numbers out there. So it's best to get that EIN. And if you're a sole proprietor, you can get an EIN also. That's a misconception that you can't, but you can. And then you'll want to open up your business bank account. It is very important to not commingle your personal and your business bank account. Try to keep those separate. And it's for a lot of reasons. One is that if you do get audited, the IRS has the right to subpoena your bank records. So now if everything's commingled, the IRS may have a hard time getting through it, and they may enter it with a little more skepticism rather than it's very organized and you keep everything separate. So go ahead and have that separate business bank account. And then also we recommend a separate credit card. And again, for that same reason, just so that everything is nice and clean and separate. And believe it or not, it makes your record keeping so much easier. That's a service we provide for everyone, but only as a complement to help. We really want to try to help our clients get their records organized. There's great programs out there now that even use AI, and they link to your accounts, make it so much more streamlined. What we used to do manually, we now leverage technology. Just like you, our industry, you're busy, constantly busy, and it's hard to take time. And oftentimes record keeping, and we'll see if everybody agrees on this webinar, but record keeping is probably the least fun, right, of your job. And it's probably the thing that you do last. You're excited to follow up with a lead, and you're excited to go to conventions and be on webinars like this. And then that record keeping just kind of keeps falling down. But it's so important to do it so that you know where your business is at all times. So once you've formed your entity, you have your bank account, your separate credit card, you can decide if it is right for you to convert your LLC or your corporation that you formed to a subchapter S corporation. And I won't get into all the details, but there are some potential tax benefits for it. But it often doesn't make sense if you're just if you're just sole proprietor, casual sales. Like I kind of give everybody a rough idea, and I say when you're on a team or you've hired maybe admin or other people to help, then maybe it's time to think about a subchapter S. Then you want to make sure you've obtained all your correct licensing in the state of Delaware. And of course, you have a professional license too. And then if you are operating in other states, maybe in Maryland, it's very easy for us to operate in Maryland, Virginia, Pennsylvania, maybe even Jersey. You need to qualify to do business in those other states. those states want to know that you're in their state, and there's a lot of required filing, and there's heavy penalties if you're not filing in those states. And that includes, I said I was going to kind of cover real estate and everything too. If you have any clients that have rentals in other states, that does trigger a filing too in those other states. Then you want to identify if you have payroll. So if you have payroll, you're required to cover them on workers' compensation. Luckily, if you're under 50 employees, you're not under some of those benefit structures, but the state of Delaware does have their version of the Family Medical Leave Act, and that is going to start taking effect. 2024, it's going to be, or 2025, it's going to be funded, and 2026, it's going to be in play. So if we have any brokers on the call or on the webinar, then know that this could affect your business because the numbers are as low as 10 employees. This is going to impact a lot of businesses, whereas the federal rule is 50. So much different numbers in the state of Delaware. Then you want to make sure you're covered too with liability insurance, professional insurance also. And then finally, you really do want to establish that method of bookkeeping and also who's responsible. It's very hard for the owner to also be the responsible party. So you can look at outsourcing services. Like I said, Fogcassin now has gone to the QuickBooks Online platform so that we're leveraging technology to do what we once did manually. That way we can provide those advanced value-added services besides, just entering and reconciling. We've moved on to trying to give better reporting, and I'll show you some examples of some reporting later. So it's very important to keep those clean and thorough records. We'll talk a little bit more about what thorough means. So clean kind of is that what I talked about, bank account just for business, credit card just for business. And then the thorough will be the extent, and we'll go over that more in detail. Your records, you should try to keep them at the time of that transaction. I don't know about you, but I barely remember what I had for lunch yesterday, let alone when we're trying to do the tax return or planning, and we're asking questions from back in February, maybe in, April or even further on in the summer, and you can't remember. And if you don't have a good, clean trail, it's very hard to go back and reconstruct. And the burden is on you to support every number you put on your tax return. The burden is on you to support it, whether it's mileage, the auto, office in the home, your cell phone, all of those expenses, meals, it's up to you to have to support those. So you really should keep that record near the time of the expenditure. And that would include mileage. So we'll go into mileage and meals and travel later and what that means. And then you need to have sufficient documentation. Now you can scan in a receipt, that's fine. Be very careful not to take a highlighter to certain receipts because the ink disappears. Like if you go to Sam's Club and you highlight the item that's business, the ink can actually disappear, and that's not a viable defense later. If you had a flood or a fire, unfortunately, that's not a viable defense. So you may want to consider scanning those documents in. And then you also, yes.
I'm sorry to interrupt. I will have a couple of questions coming through before you go on to a next topic.
Yeah.
We have one about LLC creation. Does Fogcassin help with LLC creations?
So we advise on what type of entity may be right for you in the tax structure, but then we refer you to an entity that would actually do the formation.
And secondly, there's some questions about when you were talking about separate accounts. Is it separate banks or can both be at the same banking establishment?
Yeah, great question. Yeah, they could certainly be at both the same banking establishment. As a matter of fact, that's a good idea because now with all this online banking and transfer, it'd be very easy for you to take your excess money from your business, and rather than paying personal expenses out of it, you're at the same bank, just simply do a transfer from your business account to your personal account, a draw, and then you can pay your personal expenses out of your personal account.
Thank you so much.
Yeah, thank you. Great questions. Keep them coming. So then, so the records, the credit card statement you get, that is not adequate support. because that just shows the line item of where you went. So let's say you went to Sam's Club and it was, $1,500. And you say, well, oh, there's my substantiation. Well, think about it from the IRS's standpoint. What did you buy for that $1,500? So maybe you bought a computer for the office, but what if while you were there, because I don't know about you guys, but it's a little hard to walk out of Sam's without, a lot more than what you intended to get, and you bought grapes and you bought a new TV. Well, that's not deductible per se if it wasn't for business, maybe if it was grapes for the break room, sure. But again, the IRS wouldn't know that because that $1,500 charge is on there. So it's very important for you to maintain that receipt too. And then think about using some kind of software to help you organize. Again, I bring up QuickBooks a lot because QuickBooks is fairly easy to use with some guidance and some training. It's relatively inexpensive. They do have some online versions as low as about, we have a wholesale discount of about 30% that we pass on to our clients. So clients can be on QuickBooks monthly for about $40. And if you have payroll, they offer that too. And you could be on it for somewhere around $80. So it's a good inexpensive way to organize yourself and then get that reporting too. Spreadsheets are great if you don't have too much activity and you can maintain it through there. And maybe that's a good start, but think about some kind of formal, program to use for your record keeping. And it's just going to help keep you well informed. It's going to help at tax time. I hate to hear when people say, yeah, I got to lock myself in my room in February all weekend and just work on taxes. And it's like, no, we can help you so you don't have to do that. All right, so let's talk about the vehicle. And I'll definitely pause a little bit for Denise to let me know if there's questions, because there's almost always questions whenever we talk about the vehicle. So I get this all the time of like, well, I'm in my car all the time. And so sure, we could just tell the IRS it's, 100%. It doesn't quite work that way. So if your car is parked, at your office, even when you leave your office, and sometimes now we don't always go to our offices, right? If we're with a broker, we don't always go to that office. A lot of realtors, their home is their office. So if your car stays at your broker's office or stays at your home and you don't use it to pick up the kids, take the kids to sporting events, drive to the airport for a personal trip, any of that, then fine, you could probably say it's 100%. I also get the question is, well, what if I put my logo on it? Doesn't that make it business? It's a billboard that I'm driving around. The actual logo itself is 100% deductible, you're right, as advertising, but that didn't make the car 100% deductible. You do have to support usage. That's what it comes down to. It's just how often do I use this car for usage? Estimates are not permissible. So you can't say, well, I put 15,000 miles on my car. I think it's about 80%. I'm going to estimate. Estimates will not hold up. So even though your tax preparer is taking that and putting it on the return, it ultimately will not hold up in an audit. So it is important if you were doing mixed use of your vehicle to keep a mileage log. Well, this is where I have eye rolls and sighs, and I don't blame you because I am not good at this either. So I had to develop a method that was going to help me. So there are some great apps out there that will do it. I've seen Mileage IQ. If anybody wants to put in the chat ones that they use, I've seen TaxBot. QuickBooks Online actually has a spot where you can book your mileage. Now, I tried that. I tried the app, but then what would happen, and if you're like me, sometimes when I leave the office and I'm getting ready to go somewhere, it's just in time to go somewhere. I often don't leave myself that cushion to engage an app, which those apps are great. And they actually have GPS built in, and you can name your trip, put your date in, the nature of your trip and everything. And that was a little hard for me. But one thing I'm really good at is keeping a very detailed calendar. I put everything in my Outlook, even my personal stuff. So when I put it in there, I know exactly where I went. And then after a while, your driving is pretty repetitive. So I know I go to, these couple clients often, so I know what that is. If I go down to the Rehoboth office, I know immediately how many miles that is. And so I'm keeping a detailed calendar. And then that way, at the end of each month, I can go through it and I could say, okay, I drove 500 business miles. And I can actually print that out too, out from Outlook. So that was what I did. But whatever your method is, even if it's on paper, just make sure that you're doing it. The log has to be done by the time you file your tax return. So it doesn't necessarily have to be done throughout the year, but I can tell you it's going to be a lot torturous to do it at the end of the year. And for realtors, your vehicle is probably one of your largest expenses. It is probably your largest expense if you don't have any employees that work for you. It's a big expense. Now, let's talk about the two different methods. There's mileage, which is very generous. I think it's changing for 2023, so don't quote me, but somewhere around like 63.5 cents. It's always around that 62.5, 64.5 cents a mile. That though replaces insurance, gas, repairs, and maintenance. So the nice thing is you don't have to keep track of all those other expenses if you're just keeping track of mileage. Now, a lot of preparers miss this. On top of the mileage, you can deduct finance charges for your vehicle, and you can deduct tolls and parking. So that doesn't get included in mileage. So if you pay $5,000 a year in finance charges on your vehicle and you use that car 50%, you can deduct $2,500 of finance charges. And that often gets missed. And that's a big tax savings for you. So definitely make note of that. Now, if you want to actually put the car on the books, we kind of call it, where you actually depreciate the car, you write off the insurance, the gas, the repairs and maintenance. The IRS states that the vehicle has to be used 50% or greater for business. So if you don't use it 50% or greater, you have to do the mileage method. If you use it greater than 50%, then we can look at it both ways. But the IRS does not let you flip-flop. You can't constantly go from mileage to actual depending on the year and what the benefit is. But I could tell you with the mileage rates being really high, unless you have an appetite for driving an expensive car, probably around that 80 to 100,000, which nowadays is not hard to get to, right? That's why I'm still driving my 10-year-old car, because I don't have the appetite yet for a $100,000 car. But if you do that, then maybe it makes more sense to go ahead and do the actual if you're over 50%. If you drive an economical car, then maybe you want to look at the mileage, since the mileage is in the 60. So another thing that I want to kind of add in that's fairly new, it's not new, but it's changed, and I'll talk about it now instead of the end because it's related to cars, are EVs and the tax credit. So they brought back the 7,500, and you can also take a tax credit on your return for a used EV. You never used to be able to do used EVs. You can now do used EVs. And the EV production limit. Some of you may have bought EVs in the past and then found out that you couldn't take the 7,500 because the production limit was reached. That has been lifted too. So that's a good thing. If you have your car in the books, you may be able to even deduct your charging station too. So there's some areas of that can be deductible.
All right, Tammy, before you go forward, we have a few questions, as you anticipated, about the business use of a vehicle.
Absolutely.
Can you clarify the per mileage rate for 2023? Is it 65.5 cents?
You know what? I'm not sure, Denise. I'm not sure if you're available on your computer and you could just look up business mileage rate for me.
I sure can.
It does get changed constantly, and that's a good question, because mid-year, and a lot of you will probably remember this, twice now, or maybe 3 times in my career, the IRS changed it mid-year too, where they bumped it up because gas prices went up. So it's a number that's changing constantly. And usually about this time of year, I check it out to see what it is going to be for next year.
I can certainly clarify that and post it in the chat.
Wonderful. Thank you so much.
Taxpayers, are they able to write off maintenance or repairs or part replacements on these vehicles?
So great question. So if you're doing the mileage method, no, because the mileage compensates you for all of that. If you are 50% or greater and you're doing what we call the actual method, where you're depreciating your vehicle, you're taking insurance, repairs and maintenance, tires, absolutely everything you listed, then yes. But I have to clarify, let's say the mileage says that you use the car 80% for business, then you can only deduct 80% of the insurance, the fuel, the repairs and maintenance if you're not doing the mileage. So you still have to track mileage because you're not using the car 100%. Now, if you're using the car 100%, and I can tell you, I don't know many realtors that have this designated 100%. There's a few, but you also have to prove to the IRS under audit that you have other cars registered to you that you use personally to argue that your car is 100% business. Great questions. Love them.
Now, you mentioned some additional deductions, including finances and tolls. What was the third that you listed in there?
Parking. Yep. And that tolls and parking would be 100%, whereas the finance charges would again be deductible according to your usage, your percentage of usage.
And one final one about the vehicle usage. Is there still a big deduction for a 6,000-pound car?
Great question. Yes, absolutely. So if it's an SUV and you're going to take what's called a Section 179 deduction, you can deduct right away $25,000 of that, and then you could depreciate the remaining. If it's a luxury auto, and luxury auto limits are really low, it's like somewhere around 36,000, you're limited to around $12,000 a year of depreciation if the car is under 6,000. If it is not an SUV and it's a truck and it's over 6,000, you can actually write off the whole thing. So that's called a Section 179. We do have something in the code called bonus depreciation. Bonus allowed you to do that 100%, but it just got reduced to 80% this year, and it's due to go down 20% every year. So it isn't, so now we've never really had to worry about this. We've had bonus for a really long time. So it's going to be important if you're thinking about purchasing that car by year end, you have to put it in service. That is a challenge nowadays because we often can't go to the lot and buy the car and take it. A lot of times we're having to order now. So if you order and you can't get that car till January, you can't write it off in 2023. You can't write it off until you actually put it in service. So there are some new rules with that right now. All right, thank you. Okay, so our next area we're going to talk about is home office deduction. I like to cover these areas that are kind of outside the norm. So I'm not going to cover basic expenses that you know are deductible, such as, supplies and, anything that you could say, am I doing this for my business? So your dues, your subscriptions, anything like that. I like to cover those expenses that are the outliers that are sometimes confusing and people don't know how to document. So office in the home is one of those. And this has changed. Prior to 2013, we only had one method to use. And a lot of people feared that they would be immediately audited if they took the office and the home deduction. When I first started over 30 years ago, it was pretty rare to take, and that was scrutinized heavily by the IRS. That is not the case anymore. And I love the simplified method. So the simplified method came around in 2013. And it said that you could simply take $5 per square foot of your home that you use for office up to $1,500. And that replaces you having to track utilities, repairs on your home, pest control, all of that. And also what it prevented you from having to do was depreciate your home. So I'll kind of call it the long method, and then I'll call it the $5 method. So the long method, you could take the square footage of your home compared to the square footage of your office, and let's say that was 10%. And then you could deduct 10% of your property taxes, mortgage interest, rent if you paid rent, utilities, even improvements that you did to the home. But the IRS forces you to depreciate your home. And if you depreciate your home and you sell it later, even though you might not have a taxable gain, you have to recapture the depreciation. That took a lot of people by surprise. So that's why people backed off office in the home, because they really didn't want to recapture the depreciation on their home, maybe 10, 20, 30 years later. So we have this simplified method, this $5 simplified method. It's great because when you look at 10% compared to the $5 times your square footage, yeah, maybe it wasn't as much, but now you're not depreciating your home and adding all that extra complication. Now, I want to clarify, you could only take office in the home if you're not supplied another office. So let me give you an example. Today, I'm actually in my home office, but I have an office for me that's just mine, dedicated to me. It's not a shared space. Shared space is a little bit different. It's dedicated to me. My stuff's on the walls. My, slippers are under my desk. It's my office. I actually cannot take this office as office in the home, the one that's in my home. Now, saying that, I do have in my office in the home, I have monitors, a computer, a webcam, I have my desk, I have some supplies, I have my printer. That's deductible because I'm using it for business, but my actual shell of my home, the long method or the simplified method, I cannot deduct this space. I must say for realtors over the years, this has become something that's come back because a lot of realtors don't have their own office space. They have shared space. And so now we're seeing office in the home a lot more, and we're seeing the simplified, method rather than the long method. So again, I just wanted to go over that with you. All right, so let's talk about some traps that people get into that can trigger an audit. How about we try not to even invite an audit? How about that? So what you really want to make sure is that the institutions that are going to give you a 1099 for the income, that you're actually reporting it, because sometimes you miss that 1099, it gets snuck in the mail that you don't really open, or you open it later and you didn't realize that you had a 1099 to report. So this can be on a bank account. Now that banks are paying much higher interest rates, I think we're going to go back to having 1099s for our interest income. The limit used to be $10. So if you did not have interest income greater than $10, the institution, the financial institution, would not issue a 1099 to you. So you got to make sure. And also too, we're all logging on to our bank now, and we may not be getting paper forms, but it's your responsibility now to go onto the bank, look at the section that usually says tax forms, go to the year and get your amount and report it. Another thing I've seen with realtors is that if you property manage and you also earn commissions, you often get 2 1099s. And you could be confused and think, oh, I just got my one 1099, that must have everything. Well, it may not have everything, and you could be missing that income. And the reason why it's so important is the IRS does a matching. So they're getting all these 1099s reported from the institutions, from your broker. They're reporting all of this. And then if you're not reporting that exact amount on your return, there's a mismatch. And then you're going to get a notice from the IRS. You're not being audited. You're just getting a notice, and it's saying, you reported this. We see this. We're going to charge you the tax on the difference. But that invites a second look at your return. So make sure you're well aware of all your accounts and all of your source of income, rents and everything, so that you could be reporting everything correctly. All right, so the next area I want to go into is huge: entertainment, travel, and meals. So let's dive into that. All right, so entertainment is now very important to separate out in your records from meals, because entertainment expenses are no longer deductible. Back in the day, if you bought season tickets to the Eagles, you went golfing and you invited a contractor or developer, or even went out golfing with one another. If you went on a fishing trip, all of those things now are no longer deductible. It's a shame, but I think what happened, it was so abused that finally Congress just said, nope, we're taking it out. So the only thing that is deductible are the food and beverage costs while you're at those events, but those are 50% deductible. So meals right now, the way they stand during COVID for a 2-year period, we could deduct 100% of meals. And that was Congress's attempt to stimulate that industry that got hit so hard. So 100% deductible. We're now back down to 50% deductible. Now you can still deduct your membership fees or dues associated to organizations like the Central Delaware Chamber of Commerce, belonging to DAR, your professional associations, they're 100% deductible. But now you cannot deduct your dues or fees or assessments paid to country clubs. That's no longer qualified. There's still some people that are trying that, and it's just so blatant. Unfortunately, it is considered fraud if you take it on your return. But we're going to talk about in a minute now the difference between 100% meal and a 50% meal, and this often gets missed or misunderstood. So let's talk about travel. You just went to the convention. I'll use that as an example. And you were away from your home. They kind of call it your tax home, meaning you were far enough that it wasn't reasonable for you to drive back that night. And I've even had people, so the convention, let's say it's at Dover Downs, and they're from down south at the beach. Totally reasonable for them to book a hotel stay, 100% deductible. The meal that they had while they were away from their tax home was deductible, but 50%. If you rented a car, 100%. If you flew, 100%. Parking, gratuities, all 100%. So it's just that meal portion. If somebody accompanied you that was not also in business, theirs is not deductible. But the nice thing is when you rent a car, you could still deduct the car and they're sitting next to you. You get a hotel room, is often double occupancy. You can still deduct that. It doesn't take away from it. But if you bought 2 airline tickets, just yours would be deductible as the business owner. So you have to be careful to not have, excess. So here's why I tell people all the time, be a little creative outside of your tax home. Is there a continuing education class that you could take that you can work into a trip or a destination that you want to go to? Now, I do have to say, if you take a 7-day vacation down in Orlando and you only attended a seminar 1 out of 7, the IRS isn't going to let you deduct the entire 7 days. It has to be a substantial portion of that. So let's say you're down there in 4 days, you do something related to your business, then you've made the trip deductible. But if you only do it for 2 days, 2/7 of the trip is deductible. So it's still deductible. But if you bring the whole family and the kids and everything, and you have a meal, you obviously can't deduct the meal for the entire family. People often ask me, well, what's excess? I mean, obviously you have to be able to substantiate it. If you made $10,000 in real estate commissions and you have $5,000 down as travel, that's probably excessive. It's probably not reasonable at all. But I definitely tell people to be creative. Now let's talk a little bit outside of the box. Developers, real estate developers, people that are searching for rentals. Those are investment trips that you're hunting down too. So keep track of those records, because possibly on your Schedule E, now rental income is passive. That is different than your commission income, which is considered self-employment income. So there is a distinction in it and a difference. But let's say you travel to find properties for an investor, land. And so you're kind of scoping out potential investment and it's in your realm of what you do for your business, then that would be deductible travel. You just have to document it, and it should be reasonable, not blatant.
Tammy, I have a couple questions for you if we could pause.
Okay.
Specifically, what about the Kent County Association of Realtors golf tournament every year? It's a K-car event. It still doesn't allow to have the write-off to the entry fee?
Yes, yeah. So that's different because that is in the scope of your business. So that is 100% deductible. Whereas if you just went out, golfing and happened to take someone, maybe even a client, developer, or contractor, that's entertainment. But if you're doing it within the scope of the business, like you just described, then that would be 100% deductible. Good distinction.
And I have a question. When you were speaking about taking the family on business trips and 2/7, the question was, how do you prove that? So I guess what kind of information or documentation do they need to say that this amount of the trip was for business versus, the whole thing, if maybe, the husband had the kids out or whatever and you were working hard?
Yeah, that's a great question. So let's go substantiation, really. So you're right, because how does the IRS know how many days you spent out of that trip? So if you're attending something, you're going to have a registration, probably. You're going to have materials, meeting agenda. So you're going to have all of that. So that's a good segue into how this can be expanded. Let's say you're on a team and the team wants to do an annual retreat. And you decide to drive to the beautiful Shenandoah area, which, beautiful fall foliage right now. And you leave on a Friday and come back on a Monday. So that's, 4 days. Well, Friday's your travel day. And so maybe Friday night, you have a welcome reception for everybody there. Saturday, you have an agenda of what you're going to cover. So you have that printed for your file for that substantiation. Sunday, maybe you did a team building exercise to bond the team. And then Monday, you traveled back. That would be a prime example of a full trip that would be deductible. And what you would keep, which your question was, how would you substantiate it, would be those agendas, is what you would keep. So any kind of registration agendas. Now, if you went on a trip to identify property, then you would kind of keep a self agenda. Like I drove to Maryland Shore to look at these 10 parcels. I've got it documented for client such and such. So that's a little bit more of kind of self-substantiation.
And feeding off of that last comment you just made, is there a certain amount of daily hours that qualify it to be business? Like when you were saying, if you just look at a couple of parcels, if that takes you 3 hours out of the entire day, does that still count as a business?
Yeah, it's reasonableness. So let's go back to kind of that reasonable. So a normal work day, we could all probably argue, and I know everybody on the call probably works a lot more than this, but a normal work day can be anywhere from probably 6 to 8 hours. And I say 6 because if you took 6 times 5 and you're 30 hours, most companies establish you as full-time for benefit purposes, right? So if you take a 6-hour day and you just spent 1 hour each day, maybe the substantiation, that's a little tough. If you spent half or more, you're probably going to have a better shot. Now, keep in mind, this would all be subject to examination under an audit, and you would have to make the argument of why it was necessary too. I had a seminar one time and I heard this example and it was great. So they say, well, I have a daycare and I feed the kids, right? And what if I want to give them lobster and steak every day? Why can't I deduct that? And the IRS was like, well, it isn't reasonable to feed those children lobster and steak every day. So kind of go to that example of same with this too. You're probably have a hard time if you did something for 1 hour each day and tried to write off the entire day or the entire trip. But great question. I love the way you're thinking.
That's it from here.
Okay. All right. So let's dive a little bit more into the travel. So again, you have to dictate how much the expense was. And we just talked about kind of that substantiation of the time and the place of the travel. Why was the business or the meal, business purposes? And so you have to have documentation of the actual nature of the business purpose and what the relationship was to the person that maybe you were doing that business with or for. Okay, so we did talk about meals. So I want to dive into the difference between a 50% meal and a 100% meal. So a classic example of a 50% meal is that I've got our marketing director from Fogcassin on the call, Denise. And I say, Denise, I want to take you to lunch and I want to go over the plan for entrepreneurial services next year. And we go to lunch. That is a classic meal, 50% deductible. Now let's take a look at the example of every Wednesday, our firm hosts a staff meeting and we always have a meal. That is actually 100% deduction because it's a meeting expense. And the focus wasn't really the meal, it just happened to be there. You know, our focus was actually our meeting. So think about converting from a meal to a meeting. So a meeting now can be a presentation that you do and you have food. So we've done that too. We've gone to brokers' offices, educated, very similar to this seminar we're having now. We do this seminar and we might bring breakfast, bagels, you know, might do, if it's afternoon, we're bringing some snacks. And so that's 100% because I'm doing a presentation. So think about it. If you're doing a presentation to your team and you have food there, you're doing a presentation to a developer, you have food there. Some clients, you're talking to them about a 1031 election, which we'll talk about later, and you're presenting. That is 100% versus a meal, which might be, hey, I just grabbed a bite to eat with my fellow realtor, or I'm traveling and I had to stop and eat. And the IRS's view on that is we all have to eat anyways, right? So there's a certain element of that personal aspect of it since we all have to eat anyway. So that's kind of the distinction of that.
Tammy, what about food for open house?
Yeah, same thing. That's 100% because again, the open house is really the event. It was just that you happen to have food there. Yeah. So brokers opens houses, you put food out. You got some balloons, you got some flowers, you bought maybe some pedestals and some tablecloths and you kind of decorated candles, any of that kind of staging that you did. Maybe you have frames, you know, with highlighting a picture of something that's featured. Anything associated with that would be 100% deductible. Okay. So now we're going to talk, we talked about these different elements. One other thing I want to bring that I'm asked a lot is technology, our cell phones especially. Cell phones are really expensive, really expensive. So much so that nowadays it seems like we have to have a monthly payment on it because it's hard to pay $1,200 for a cell phone up front. But it is very often too that you don't have two cell phones, right? And some do, some people do. They have one for business, one for personal, so they can kind of separate that nicely and don't feel like they're answering their phone 24/7. But a lot of people don't. They have one phone. And so how do we deduct that? Because there is a personal element to it, right? And often too, we have plans that we've got 10 people on our plans. We're like, sure, jump on family, you know, because everybody's $20 extra a line. And then what do? You just write off your, you know, bill through your business account. Well, this is highly scrutinized if it does get looked at, because obviously everybody else on your plan isn't deductible. So if you're the base one, the baseline, yours can be deductible, but this is another usage one. Now, this is impossible to track your daily activity. Now, keep in mind, there are call logs, you know, I just don't think the IRS would dive down that deep. But I found that as long as you have some kind of reasonable allocation, so you can say, all right, I'm a broker. I'm pretty much almost on call 7 days a week because I have, you know, agents out there and they're working sometimes 7 days a week and they're not working traditional hours. I mean, how many times are showings all the way into the night and they're on weekends too? So you could have a good argument to say, yeah, although this is also my personal phone, I really say it's like an 80-20 split. If I looked at my days of calls that I get and conduct on it, you know, I probably use it 80% of the time. So it's going to be reasonable to back out about 20% of it. Same with a realtor. You could have that same argument and say, hey, I don't just show homes, you know, 5 days a week. I'm also in the office. I'm participating in events too. And I really do feel like I use this phone 7 days a week. And, you know, maybe, like I said, you could decide based on when you really looked at like an average day, what is that percentage, so you can back off some of it for personal use. But they're certainly going to, IRS would certainly scrutinize if you had multiple lines on there with family members that's not your phone. So just be careful of that area too. The actual phone itself is deductible, but again, based on use. So if you bought a new phone or you're making a monthly payment and you did determine that 80-20 is that fair representation of that phone's business use, then we would deduct 80% of the phone. Okay, so now we're going to dive a little bit into deductions that are typical for your industry. I'm going to show you more of a manual format, and then I'm going to show you a little bit about what QuickBooks could look like if you did automate it. So what we're looking at first is kind of more the manual format. We have this in electronic form, so I could certainly get it to Matt at Delaware Association of Realtors, and it could possibly be dispersed out. We do have this form in electronic, whereas the next slide I'm going to show you is an example of what it would look like within QuickBooks, which you would have to subscribe to that software. So again, I'm not going to read these line by line. This is for you to kind of look at. Some of these things are obvious. You know, I obviously advertise, and I have fees, and I have client gifts. So let's talk a little bit about that too. The IRS has really never increased what is considered a deduction for a gift. It's a little embarrassing that the IRS still has it at $25, because $25 in a gift that you gave back in the 90s really isn't the same gift that you give now. So technically, if you give someone something more than $25, it's supposed to be taxable compensation to them, which is ridiculous. You're not going to send them a 1099 because you gave them a $50 gift certificate at a restaurant. So what we've told people is that if you do give a tangible client gift, like it's very popular now to give charcuterie boards, frames, you know, picture frames, maybe a set of, like, maybe you know that your clients are wine connoisseurs, or the contractor or developer likes bourbon, and so you want to give them something like that. If at all possible, you could put your brand on it, then you've kind of converted that from a gift to advertising, and that's going to help your case even more. So maybe you have, like at Fall Cassim, we have gifts that are probably valued over $25, but our name is going on it. So we're kind of converting it from a gift to a promotion. A restaurant gift card's a little bit harder because, again, $25 might not get you too far, depending on where you're giving this restaurant gift card to. Might need to be more like 50. Well, if it, let's say it was 2 people that were your clients, you know, you could argue, okay, it was really $25, you know, per person. But those are deductible completely. Any kind of your photography fees, your staging, anything like that. Now, keep in mind, you are a business. And so if you pay another person or business to do professional services for you of $600 or greater in a year, you're required to 1099 them. And if you don't, there are substantial penalties for this. And if you have to submit more than 10 of these forms between W-2, so if you have employees, so this is really important for brokers. Realtors might not get to this level, but let's say a broker has 2 employees and they 1099 15 realtors and 5 professionals, starting with your 2023 forms, filing in 2024, you must e-file these forms. This is huge. There's big penalties for not doing this. And if you don't do an e-file and you say, well, I'm still going to send it in paper, you will be considered non-filing and you're going to have penalties. If you are with QuickBooks, QuickBooks does have a mechanism that you can file them. It's called Tax 1099. And they use a program called Tax 1099. Our firm has vetted several different softwares and looked at them, and we are actually going with Tax 1099. We support QuickBooks, but we're going with Tax 1099 also. So if you are not in QuickBooks, or you don't want the hassle of filing these because you're not sure how to fill them out, firms often will do it. I know our firm is going to do that for any client. You have to be a client of our firm, and we will go ahead and file and make sure that everyone is compliant. So this is huge. It's not new that you had to do 1099s. You always had to do 1099s. It's new now that you have to e-file them, and the form cutoff is 10, and that includes W-2. So big. We again have these in our newsletter and blast often. So these kind of things that I've been going over, we're constantly trying to educate everybody on, because there's big penalties in this. And as I was talking about the formation earlier on the first slide, you know, yes, that has nothing to do with tax, but we feel so strong about educating because you oftentimes don't have the resources. So you've got to hear it, you know, from somewhere. So I'm very passionate about educating everybody on this. All right, so that's an example. Photography fees is an example of someone that you may need to 1099, or if you have somebody that's like a party planner or an event specialist that you hire for different events that you do, and you pay them over 600, that could be a 1099 too. Again, it's for services, not product. So it would include your CPA and your attorney. Those are all included in there. But if you actually bought something at Lowe's, Staples, whatever, Amazon, that's not subject to 1099. At one point they talked about products too, but they backed off of that because they realized it would just be way too much volume. So now it's just services and commissions in the case of, you know, real estate and whatever. So you can deduct also fees you pay to maybe you have sales assistants. And you have to be careful if they're a contractor or an employee. I won't go into the differences of that because that's a pretty big discussion, but either way, you can deduct those. A sales assistant as a contractor, again, would be someone you would 1099, whereas if you had an employee, they would get a W-2, but you're required to have workman's comp on them, and you do have to match their payroll taxes too. So technology, we talked about the phones. We won't talk about that anymore, but your computer, maybe you have a separate camera, maybe you've purchased a drone because you kind of do your own, you know, footage of that too. All of that could be deductible. You know, if you do have a scanner, I used to say fax machine, but I think that's gone kind of archaic. Most of the time people have scanners now. You have video cams. Like I have a little separate one so I can move it around, separate from my laptop one. Speakers, lights, you know, any of those kind of things you can deduct. And then office supplies, you know, the details, pens, paper, whatever, you know, you can deduct. Continuing education, not only the cost of the continuing education fully, but then we talked a little bit about travel already. And then of course, if you're paying desk fees or anything like that. So I always tell people, if you can answer the question, am I doing this for business or am I buying this for business? And if the answer is yes, then it's deductible. But then you have to do that deeper dive of a substantiation, which we've talked about heavily, substantiation. So it's very important. Oh yes, Denise, something.
Sorry. Keep taking a breath to start, and then you're like, oh. I just wanted to clarify a couple points. So if they pay their photographer more than $600 in a year and they write that off as an expense, they still have to send them a 1099?
Absolutely. Yep.
And what about paying for a client's inspection cost? How is that treated?
Oh, that's a complete deduction. Yeah, so that's often happens. You might pay for the appraisal, the inspection. I've even seen it last minute where the deal's going to fall through and there was some kind of small repair. They paid for that. They might have paid to have the grass mowed at the place, maybe have the place cleaned. All of that is in the ordinary course of business, and it is deductible.
Excellent.
Mm-hmm. You know what, though, you did bring up a good point that I do want to clarify. The nice thing is if you pay for any of these services that I said are subject to a 1099, if you pay for them via credit card, you do not have to 1099 them. And the reason why you don't is because there's a thing called a 1099K where they get it direct from that third party pay. So gosh, what do we have out there now? We have the Apple, Venmo, Zelle. I mean, we just have a ton of them. That is facilitated a little bit differently. So for example, when we have clients that pay us on credit card, then they do not have to 1099 us because that's through 1099K format, a little bit different. So another benefit of just being more automated, and plus you get the points, you know, often through your credit card too.
Tammy, I believe this question popped up when you were speaking specifically about the client inspection costs, but is there any like guide they can use to know what category to place these items under when they're tracking them? Specifically about the client inspection costs, what category would they go under?
Yeah, it's I wish I could tell you there was some kind of guide you could go to. I mean, there is a publication that the IRS has on Schedule C's, people in business, that you can go to. If you're really excited about reading, you know, a lot of material, it'll certainly maybe put you to sleep. So here's what I tell everyone: an expense is an expense, except for like a meal that's 50%, right? Or your auto that we talked about being a little bit differently. But let's just, other than those outliers, an expense is an expense. So whether you called it on your return professional fees, which there is a nice little clean box for professional fees. So I would say, if you're asking me what line that fit on the best, it would be professional fees. But if you put something in supplies, and maybe it could be argued that it was, you know, on a different, should have been on a different line: advertising, professional fees, supplies, repairs and maintenance. If you put it on any one of those, your deduction is the same. So there's really no wrong answer. And the IRS isn't going to come in and say, oh, you put that on professional fees and you should have put that in advertising, we're taking the deduction away. Because it doesn't matter, because all of those are 100% deductible. And so you don't have to worry about technically what line they go on. But to answer your question more specifically, it would go in professional fees.
Do you have any feedback on home warranties? What category?
Probably same thing. I would say professional fees. Yep.
And it seems like there's a little bit of misunderstanding about the 1099 still. So if you just clarify, regardless of how the photographer is paid, if it's over $600, it needs a 1099 filed.
Well, not regardless. So, and I may have confused this a little bit. So if, because I made a comment at the end about like paying them via like a third party.
Yes, they're talking about the Venmo or Zelle.
Yeah, okay. That would prevent you from having to send a 1099. That would. Otherwise, if you're paying them by check, even your mobile banking, then you would have to 1099 them for services greater than 600.
Good question, Joyce.
Yeah, great question. It's I tell you, it could be, it's what do they always say? The devil's in the details. It certainly is with the IRS. It's full of ands, ifs, and buts. It's just never, it doesn't seem to ever be super clear. So I'm loving the questions, because these are common questions, and I guarantee you, if you have them, everybody has them, you know, too. So keep them coming. I love them. All right. So we've kind of talked about the way you can manually do it. Let's convert to what it might look like if you use a program such as QuickBooks. So we have a sample realtor. And the nice thing is, I wanted to show you how you can separate your income and really look at it. This is important. I often sit down with brokers and take a look at this, whether they're getting the buyer sales or the listing sales. And sometimes we even drill down and we look to see what the brokers close themselves, because we want to see how much of revenue they're producing. Because obviously, if the broker's producing it, it's hitting the bottom line a little bit greater than if they're getting, you know, a split on the commission. So there's a way then that you could separate out your listings and you can see. And then I even put a section of income that is your rental income. Most of the time, this would be for your property management income. You can, if you own rentals personally, QuickBooks does have a way that you can class it, because that does get reported 2 totally different ways on your tax return. So rental income is passive, and your real estate income is considered active or self-employment. And you don't want to commingle the expenses, and you don't want to commingle the income, because they're taxed completely separately. So if you do want to use one QuickBooks for both, it will be very important to class those. Or you can do what's called job costing, where you can set up 2 jobs, one called, rental. And then if you have multiple rentals, you can set up each property too. And that's just going to help so much more for your record organization, for any strategic tax planning, and actually filing your tax return. So I just want to show you though that it does have the capability of splitting that out. And then your cost of goods sold, what cost of goods sold is, or you might have heard it referred to as COGS. These are your direct costs associated with the income you make. So you have some direct costs, and then you have general and administrative. So general and administrative would be your insurances, your advertising, because you're just doing that in general. But if you want to track direct costs, those would be just like what you brought up before, your inspection fee that you paid for, your photographer, because you really want to look at those direct costs and say, well, how much of a percentage am I spending in direct costs to earn the money that I'm earning? And those might be costs that you could do something about. Whereas your general and administrative, insurance is what insurance is. Dues and subscriptions is pretty set. To a certain point, professional fees, office supplies, all that is pretty set. But your cost of goods sold, or your COGS, can vary. And maybe you're going to find that you're actually spending a lot of your commission on those expenses. And maybe that's necessary. Maybe you need to do that to increase your revenue, to be able to increase the bottom line. So this is a sample of what a profit and loss could look like. The nice thing about QuickBooks is you can run it for any period. You could run it for a day if you wanted to, a week, a month, a quarter, or the year. We often try to help clients organize so that they're looking at it often, at least once a month. And then most clients want our involvement quarterly to really talk about that bottom line. So if you look down all the way at the bottom of that form, we've got net income of $4,770. So maybe over a whole year, that's probably not going to create a big tax bill. That's kind of good. But if that's just for a month, you might have a pretty substantial tax bill. So let's talk about a little bit about what taxes might look like on your net income. So you pick up all your gross revenue, and you do have to report that on your return, whatever return you report, whether it's a sole proprietorship, so it would be your personal 1040 Schedule C, a partnership return, because there's 2 or more of you, or a sub S corporation, which is still basically, it can be a person who's just by themselves, or it can be 2 or more. So that entity is for any number of owners up to 75. So let's talk about what the taxes would look like for a sole proprietor and a partnership, because they're relatively the same, or that LLC like we talked about earlier. You're going to have a couple components of your taxes. You're going to have your federal tax, your state tax, but now you're going to have that self-employment tax I keep talking about. That self-employment tax consists of Social Security and Medicare. When you're an employee of a company and you get a W-2, you have Fed and state come out of your wages, and you also have Social Security and Medicare coming out of your wages. But your employer is matching your Social Security and Medicare. When you're self-employed, you are the employee and the employer, and you're paying both shares. And that is a shocking 15.3%. 15.3% is what you're going to pay on your net income. That's income after expenses. You're going to pay, and you haven't even paid Fed and state yet. So we've seen some pretty big numbers from realtors. Maybe not 2023. It's been a little bit of a downturn, especially prior to that. Easily realtors were earning 300,000 in the gross commissions, and your expenses. I mean, my gosh, after you paid your fixed expenses, you just really didn't have that many, expenses. So with realtors that were making $150,000, $200,000, $250,000 of net income, and we're just totally shocked by the taxes on it, because again, you had that 15.3% of Social Security and Medicare. Now, Medicare, you're taxed there's a component of that 15.3, 2.9 of it's Medicare. That's on the whole amount of your net income. Social Security is 12.4 of that. That is capped though. So the new cap for 2023 is $168,000 net. So once you make over $168,000 next year net, you will no longer pay Social Security. So you'll get a little bit of relief on that 12.4, but you're always going to have that 2.9. Now, when you're a sub S, a little different. You pay that Social Security on your wage, but then if you take distributions, you don't pay Social Security and Medicare on distribution. So a little bit of a distinguishment between that in case anybody's wondering what the difference is between the sub S. So now we've established we're going to owe this 15.3. The good thing is the 15.3% you pay is tax deductible. So it averages down around the 12.5, once you get factor in that you can take that deduction. Okay, so let's kind of keep that in mind. We're already out 12.5% on our net income. Now we take this income and we put it on our personal return. If all we have is that, then we look at what your rate is. And sometimes people think your bracket is your rate that you pay on all your income. You don't. There's 7 brackets and you pay a little bit at each bracket. So everybody pays tax at the 10%. Then you go to the 12, 15, 18, 20, so on and so forth, all the way up to the 36. So if you're in the 36% bracket, you don't pay 36% on all your income, just on part of it. So then we take, that's called your effective tax rate. Most people are in that 18 to about, 28% effective rate. Most that I see that are in real estate, 18 to 28%. So let's assume you're in that 18. Now we got to factor in your self-employment of 12. Let's just round it down to 12 for the sake of math. So now we're at 30%. 30%. And we haven't even gotten to the state yet. So now let's go to Delaware. Delaware gives you a standard deduction if you don't itemize and $100 tax credit. Aside from that, though, most people I see pay an average of 3.5% up to about 6%. So you're at that 30% on the low end, and we just now added another 3.5%. So now you're at 33.5%. We didn't even talk about people that are in the higher ends because maybe you're married filing joint and your income together is up around that 28 I was talking about. So now if we take the 28 and we add it to the 12% self-employment, now we're at 40, and then we add Delaware that might be closer to about 6%, 46% as being self-employed is what you could potentially pay in taxes. That's why it is so important. And I've spent my life, I feel like, trying to prepare people, because some of you, I'm sure on this webinar, have been caught by surprise and were told in April that you owe $30,000, $40,000 and it completely caught you by surprise. And you can't do much in April because you can't buy that car now. We do have some retirement benefits. So let's talk about a few things that are very popular deductions that you can do to possibly get that tax liability down a little bit. So we've already talked about some things like travel, trying to get some trips in, whatnot. There's a thing called income shifting. And if you can possibly shift any income to someone that pays lesser tax than you, that's a good thing. Now you can't just do it arbitrarily and say, oh, I made, $250,000. I'm just going to say that I paid my 15-year-old child $50,000. You can't just say it. It actually has to happen, and they have to have performed services for it. Or maybe you have parents that are retired and they're on fixed income and they sure could use a little bit of income, and you give them marketing services, office services. Maybe they man open houses for you. Maybe they run errands for you, and they can earn, maybe they're on Social Security, so they can't earn much, but they can earn $15,000, $18,000. You can pay. So if you pay these children, or anyone really, but it's more common for children or parents, pay them for these services they perform, you get that deduction. So if you're in that 46%, or even if you're not in that 46%, but you're in that 33%, and you say, well, gee, yeah, my parents do all this for me and I help them out anyways. Well, why not pay them? I pay them 10 grand. You just saved $3,300, or maybe you save $4,600. That is huge, huge tax savings. So I always tell people to think about the savings in that pennies on the dollar. So convert that percentage to, I saved 33 cents on the dollar. I saved 46 cents on the dollar. That's impactful. And sometimes it's not impactful for one thing, but if you put all these things I'm telling you together, you might save several thousands of dollars. So let's talk about the children. This is, so you might say, well, I don't want to lose the children as a dependent. This does not mean you lose children as a dependent, because you're still paying for their basic needs, which are, food, clothing, and shelter. So let's say the children do a service, you could pay them. So they may have to file a tax return, but $12,800 is their standard deduction for Fed. The state is lower, so you could end up paying a little bit of state tax, but they file a tax return, could pay no federal, very little state. And now let's go back to you. You're saving then that 33 cents on the dollar or 46 cents on the dollar, or those percentages, and they're possibly not paying any tax or very little. Maybe to the state they paid a couple $100. That is really worth it. And you put it together. So I had someone once that had 3 kids, and we put the 3 children on payroll because they'd legitimately performed services. And they got, at the time, it was around $10,000. They were paying them $30,000. Think about if they were in that 33% or 46%. We came up with a strategy that saved them anywhere from probably $10,000 to $15,000 in taxes. And then they say, well, gosh, how do I afford to pay my kids that when I'm still paying for all this other stuff? I said, well, this is time now you think outside the box. Sure, you're not going to charge a kid rent. You're not going to charge them rent for staying in your home or groceries. So that's not realistic, because you still have to give them those basic needs. But any of you who have children, on this webinar that it is expensive to have them in sports, travel leagues, maybe excess, they go school shopping, and you kind of say, hey, I'm okay with spending, I don't know, whatever's reasonable now, but you want that extra, outfits or whatever, you're going to pay for that. So any of those kind of things, have the child pay for their own expenses as far as that goes, and that's okay. Now the IRS does say, so again, remember I was telling you can't just pretend you gave them the money. You actually have to give them the money. It's called constructive receipt of the funds. The kids actually have to have the funds, but you don't tell the kids. So this is what I did. So I had my daughter on payroll. I certainly wasn't going to tell my 15-year-old that I just put, over time, $10,000 in her bank account. Certainly wasn't going to tell her that. She was a minor, so I had a uniform gift to minor account. And so, I had access to it. And then when she had things that were extra, we paid for it out of there. Then once she was 18, technically she was entitled to that account. But I gave my child a nice start. When she had her first home, it was the down payment. One other strategy I did too for my daughter is then I contributed to an IRA for her, because anyone that has earned income, and this is considered earned income, they are now eligible to contribute to an IRA. So I didn't do much, but I did it regularly over 5 years. And we left that money alone, and it's really grown. And she's now in her late 20s, and she now has $55,000 in an IRA from me just putting little bits in it. And the nice thing is she can use it for a first-time home purchase up to $10,000 without being penalized. She can use it for education if there were medical expenses. So I felt like I gave her a great start, and I'm trying to encourage her and educate her to add to it too, because now she's seeing the power of how much that money has grown, in this time period. So huge fan of that income shifting and doing it correctly. So there's some strategies again to get that tax down. And then retirement.
Oh, Tammy,
yes.
I want to interrupt for 1 second. Can that strategy be applied to a spouse?
Good question. Very good question, because if you married filing joint, and I'll clarify, because sometimes people then think married filing separate would fix this, and it really doesn't. If you're married filing joint and you take and pay them $50,000, so you get a $50,000 deduction, they have to pick up the $50,000, which is taxable income, and you two are together anyways, so you really kind of didn't accomplish anything at washed. Now, here's part two to that. It is beneficial if then that spouse contributes to retirement and reduces that $50,000 down, then we've kind of diluted and helped that wash a little bit. So there can be some advantages, but if you're not going to do retirement and all you're doing is taking this 50 and shifting it to this 50 and you're married filing joint, it isn't really going to benefit you at all. And if anything, if you're over that $168,000 Social Security limit, you just created more Social Security tax because it's on their 50 and you could have been possibly out of paying that. So we really have to look at that case by case. It's not always beneficial. Married filing separate really doesn't undo that either. So yeah, so it's a kind of a case by case strategy, but an awesome question.
And if they do pay their children for services, do they need to file a 1099?
Yes. You either have to do a 1099 or a W-2, do a W-2 if they're an employee. Yeah. The nice thing, so this gets a little more in the weeds, but let me just, since you kind of brought that up, if you pay a child for a W-2 and you're a sole proprietor up to age 18, that child does not have to pay Social Security and Medicare tax. So there's where's an advantage of making it a W-2, because if you do a 1099, they're a contractor, and then it kind of gets, the waters get a little bit muddier. But the nice thing is sole proprietor, remember sole proprietor, age 18, no self-employment tax. If you have a subchapter S corporation, you are going to have to pay that Social Security and Medicare. So now that 33 and 46% example I gave, you just brought that advantage down by that 12.5. So now it might only be saving you, 15 to 20% rather than 33 to 6%. Love these questions. These are awesome questions. Everybody's paying attention. This is great. Okay, so let's talk about what we were trying to do is reduce your net income so we could help relieve some of these taxes, right? So just to recap, we talked about making sure you understand how to write off your auto, how to write off your cell phone, office in the home, travel, trips, talked about all of that, income shifting. So you see now we're kind of got all these things that if we put them together, maybe it's going to be pretty substantial and we can save, rather than 100 here and there, maybe we could save thousands and sometimes even, $10,000 of tax. So let's talk about retirement. If you're a sole proprietor and you have no employees, you can do this thing called a SEP. And a SEP plan is awesome because you can contribute 25% of your net income. So if you have $100,000 of net income, you could contribute $25,000 to your SEP. You can go as high as $63,000 in a SEP. That's the absolute max that the IRS allows for a combination of retirement, giving and plans, $63,000. You can also do what's called a solo 401k. A solo 401k allows you to contribute $22,500 and then do a match. And then if you're over 50, you could do what's called a catch up. So it's pretty big dollars too. And these amounts change every year. The 22,500 gets indexed for inflation. The catch up of 18 is now 20. So you're now up into the 40,000s where you can do this. Now, if you have a subchapter S corporation, it's a little bit different. You can have what's called a simple, or you can have a 401k. You may be required to match of your employees. And you may not want to do a SEP if you have employees, because if you put 25% of your pay or income into a SEP, you have to match that and do 25% of your employees' pay, which you may not want to contribute that much. You may want to give them a little bit, but maybe not 25%. So there's so many avenues for trying to get that net income down. You can also do simply an IRA. So an IRA with $6,000 limit, 7,000 if you're over 50. So you could possibly do an IRA. So, now there's dates. There's very specific dates of cutoffs of these contributions. An IRA has a very strict cutoff of April 15th of the following year. So if you make an IRA contribution by April 15th, you can take the deduction on your previous year's tax return. A SEP plan also has the April 15th deadline if you're an individual, but it has a March 15th deadline if you're a corporation. But the nice thing about a SEP is if you're extended, and some of you maybe get extended, personally, you're extended until October 15th, and corporate-wise, you're extended till September 15th. You actually have until the extended due date of the return to make the SEP contribution. So that expands way out. Now, solo 401k, the part that comes out of your pay actually has to be contributed within 30 days of the time it came out of your pay or your employee's pay. So there's a lot of dates, but just keep in mind that you do have a little bit of time that creeps into the next year. Also, too, if you say, well, gosh, I'd love to do 40 grand, but I don't know if I'm going to have 40 grand all at once. You can contact your financial advisor and you can spread out over time and have them take out of your bank account or your pay. If you are a corporation and you get a pay, you can have them deducted and taken out incrementally each time. I don't know about you, but it's a lot easier to come up with maybe $1,000 a month than $12,000 at the end of year, or $200 a week, rather than coming up with $10,000 at the end of the year. It's easier when it's incremental. So I do want to talk, so when we put all those things together, it could be very impactful. But I do want to say that retirement, though, saves federal and state. It is not a deduction for Social Security and Medicare. I wish it was, but it's not. I also get asked all the time about HSAs and health insurance. Love HSAs. Those are health savings accounts, and the limits are pretty high. I think a single, somewhere around maybe like $3,800 that you contribute a year, around $7,750 for a family. But you have to be this is part of a high deductible plan. So you have to be considered to have a high deductible plan. Then you can contribute into an HSA. This is just what it says. It's a health savings account. It accumulates tax-free. So it's kind of a built-in savings account. And there's no limit to the years that you can have it accumulate. So every year you can keep putting this money in and its earnings keep accruing tax-free, which is beautiful. And then later on in life, I have a lot of clients that are kind of building this up to the tens of thousands of dollars, so that later on, when the dental bills become quite expensive, implants alone could be tens of thousands of dollars. A crown, a cap, all of these things are well over $1,000 now. I had somebody that just said they went to the dentist and spent $4,000. You can take that out of your HSA completely tax-free. Prescriptions, your co-pays, you can even pay for the premiums out of the HSA account. So HSAs are wonderful wealth accumulation, and it is deductible on your return as being self-employed. You can also take your medical insurance premiums, whether you're part of a group or you're on the marketplace. The premiums you pay are also deductible to self-employed individuals. Now, they are not deductible as a direct business expense. So again, you do not save that Social Security and Medicare tax, but you do save the federal and state. So now if we put together the HSA and we combine that with the medical insurance, and then we have retirement, income shifting, and then all those other expenses that I gave you ideas of how you can track them, everything put together could be very substantial. Now, you do have to have the cash to do these things, so it does require some planning. So again, you go throughout the year and you're making money and you're like, well, I don't have any cash, so I think I'm okay and I don't owe taxes. Well, draws that you took out to pay your mortgage and grocery and maybe daycare and expenses that you have, that's not deductible. And the IRS doesn't like it when you owe them big amounts at the end of the year. So the IRS states that you cannot owe them more than $1,000 with your tax return without being penalized. You will be penalized if you owe them more than $1,000. So you're required to make estimated tax payments quarterly, and they're due April 15th, June 15th, September 15th, and January 15th. And they're based on what's called a safe harbor, which is last year's taxes. So as long as you pay in 110% of the previous year's taxes, then you can owe come tax time April 15th and you won't be penalized. So it's called the safe harbor rule. So you definitely want to make sure that you're paying in estimated taxes. All right, so let me see if there's any. All right, just in case we miss questions, we'll certainly come back to those. All right, Denise, are we good to go on to section 1031 or should I pause?
We just have one. Can HSA contributions and healthcare premiums be paid on behalf of employees outside of payroll?
Oh, outside of payroll. Yes, you can offer the benefit. If that's the question, you can offer the benefit and pay for it. That is a 100% deduction for your business. Now, let me answer maybe the follow-on question that I get asked a lot. What if your employee, it's cheaper for them to get insurance on the marketplace and it costs $400 a month and you want to pay them for the marketplace? That unfortunately is considered taxable compensation, and you would have to pay them the $400 in their wage because you cannot pay for their health insurance premiums through the marketplace. It has to be a group plan that you're paying for your employees' health insurance.
That was the only question we have right now.
Okay, and an employer can contribute to an employee's HSA too and have it be deductible. But again, you have to have a high deductible plan to have an HSA. It's not hard to have a high deductible plan. The deductions are pretty low. I want to say for family plan, it's like $3,000, and maybe single is somewhere like half of that or something. So not hard to have a high deductible plan. All right, so let's talk about a section 1031. This is a pretty complicated area of the tax code. I'm going to just give you the highlights because I think it's important that you know, but that you also know enough to say, whoa, I just know a little bit about this, but please talk to an accountant about this. I'm always saying, talk to an attorney, an accountant, financial advisor, an insurance broker, because these are areas that could be very complex. And I should never be giving advice outside of, tax. So I'll give you kind of where this is very helpful. And we've seen more and more of 1031s now because of the appreciation of properties. Now, I do want to say that 1031s are not for primary residences. This is for investment properties, but they're unique because they're treated kind of as an exchange. So 1031s are really called like-kind exchanges, and it's an exchange for property. So sales are taxable with the IRS, but 1031s are not because they're an exchange. But we kind of kick the can down the road. We take that gain and we don't pay taxes on it today. But if we ever go to sell that 1031 property, it could be subject to taxes later when you go to sell it. So things that the code section for 1031 does not apply to. It does not apply to stocks, or if you know a developer that's holding land for inventory because they're going to develop it, that does not count. Inventory, so inventory does not count. But if I own a lot and I want to sell it for $1 million and I'm going to have a $500,000 gain and I see another lot I want to buy, that qualifies, just as long as I'm not holding it for inventory because I'm going to develop it. So any kind of stocks or bonds, any kind of securities, interest in a partnership is not subject to a 1031. So think more real estate. And then any kind of certificates of trust you can. So again, let's think real estate and let's think for investment purposes. So there's very, very specific rules on this. So the property you're going to buy has to be identified, and the exchange, which means the sale, has to be completed not more than 180 days after that transfer of your property. So what that means is I sold a property and the gain funds got held by a qualified intermediary. The funds have to be held. You cannot take possession of this cash. You have to have the funds held by the qualified intermediary. They hold it until you go to settlement on the new property 180 days later. Now, these properties, though, have to be identified 45 days after you transfer your property. So you don't have 180 days. So I sell my property. I have 45 days to identify my property I'm going to buy or properties. The nice thing is I could sell this one property, property A, and within 45 days, I could identify property B, C, and D that I'm going to buy with property A's money. And then I have 180 days to actually execute the end of the transaction, the actual purchase. Now, I talked about having to hold the funds with the qualified intermediary. What if the funds are $500,000, but the replacement property is only $4,000, and I'm going to take possession of $100,000? Just that 100,000 portion. Now there's a formula, so it's not as clean as 100,000. That portion will be taxed. So you can still avoid tax on a large part of the gain on a 1031. All right, so I don't know if we have any new chats on that, but that's basically the overview. Let me give another couple examples, like a rental property. I have rental properties, and let's say I've got equity of about $1 million, and then I have 7 rental properties and I want to sell those. And then I find one single rental I want to buy on a lake and rent it. That's okay. That qualifies because it's like kind. Land qualifies, rental properties, just like I said, not primary residences. Okay, that's a heavy duty topic. All right. So let's talk about some of the things that are ahead. So some of you may have taken the ERTC, which is the Employee Retention Tax Credit, because you had employees during the time of 2020 and 2021. Well, there's a lot of fraud in this area, as you can imagine. Fraud so big, it's going into the billions, which is quite shocking. And so right now, the IRS has put a moratorium on applying for any ERTCs. So if you file one right now, they're auditing. We've been told they're auditing all of them, and they're putting a moratorium on it. There is something rare they're doing. Let's say you let one of these companies talk you into doing an ERTC, and now you're not feeling so great about it, because there's a lot of companies out there that have really definitely pushed the envelope and probably applied for ERTCs that they shouldn't have. So what happened, and this was due to the shutdown, you had to suffer a partial or a full shutdown, or you had to have a drop in revenue of 50% in 2020 compared to 2019, or a 20% drop in 2021 compared to 2019. And again, this is if you had employees, and you cannot include family, unfortunately. So if you had yourself on payroll, 3 kids, mom and dad, unfortunately, you can't deduct those for the ERTC. So I just want to bring it up because there's a lot of fraud in this area, and there's a moratorium on this, and guaranteed audit. And also too, they're letting anyone who applied for the ERTC withdraw their claim, even if they're being audited, which is rare. You usually can't withdraw a tax return once you filed it under audit. This is one of the areas that they're letting you. Also, the Secure Act 2.0, some of the implementation has been delayed on some things, like automatic enrollment into retirement plans. But there's a thing where if you inherit an IRA, and you're a non-spouse, so maybe you're a child or you're a relative and received it, you do have to withdraw it over 10 years. So there's some new things as far as that goes. We've been very lucky that we haven't had too much legislative change. I did tell you about the EVs. This would have been the time I would have covered the EVs, but I did that back when we were talking about the cars.
Tammy, I have one question that came in after you had moved on to another topic, but can exchange, hold on, let me reread this in my head. Can exchanging a residential rental with a commercial property can be considered like kind?
Yes, yeah, because they're both investment. Yep. Yep, great clarifying question. All right, so is there any questions come to anybody's mind, even on something that we did cover way back when? That's okay that we can answer that. I really appreciate that you guys asked along the way, because I think it's relevant, and then it kind of helps us, helps the topic matter stick a little bit more. I do want to, I mentioned earlier in the podcast, or in the webinar here, that we do have a podcast, especially relative today. The one that drops talks about that new filing requirement if you're an LLC or a corporation. So that's pretty important. And then this is my contact information too. If you do want any further content on what we talked about today, or that sample, deductions, anything like that, I can certainly share that too.
I do have one lingering question, Tammy. When we know that Fallcastle really leans into QuickBooks Online as our go-to, but have you had any feedback about things such as Truebill or Rocket Money that lets you put money into categories as well?
Oh, okay. Yeah, I've seen. So we don't necessarily support that software because it's hard to support all the platforms out there. I have received the output though from it, and it was very useful. This was somebody, again, that put it kind of in those buckets that I showed before, and totally useful too. So I would say it really comes down to cost and ease of use for you. I just stress organization, and do it any way that you're comfortable with. Just do it, because organizing will be so beneficial, especially when I was talking about that 33 and 46% tax savings that you can experience. And it's crucial to do it throughout the year. You still have time. It's November 3rd. You do have time. So don't worry if you're panicking and going, oh my gosh, Tammy's made us all panic. It's too late. No, now's the time. Dedicate the time now, and I promise you it'll be worth it.
What is the acceptable way to designate the property to be exchanged for in a 1031 exchange?
Most of the time it's an intent to purchase or a contract. Yeah, in the identifying.
That wraps up what I have here in the chat.
Wonderful.
All
Thank
right.
you so much.
Thank you, Tammy. I think this was very insightful, and I hope everybody who attended and those who watch the recording later will at least take one takeaway from this.
I hope so.
So thank you again. If anybody else has any questions, please put them in the chat. Tammy or Denise, do you guys have anything else to add?
No, I do not. Again, just Matt, thank you so much for having us. This topic we're very passionate about, and we really enjoy, that you've given us this opportunity.
Yeah, and thank you for doing this. To everybody on the chat, or to everybody attending this, we will send out the recording shortly. And thank you for attending. Thank you, everybody.